Today we are going to touch upon the concept of index fund. It is by far the most powerful concept that you will study in this course. If you're just able to understand this concept and use this for your financial planning, you're good to go. This is an extremely powerful concept. It's a very simple concept, but a very powerful concept. Index fund is like investing in country's economy. And if you're bullish that your country's economy will grow, the best way is to invest in index fund. Now, and you will be surprised that it's very easy to invest in a country's economy than you can imagine. So we'll touch upon this concept in this session today. Now, why do we need an index? The three reasons why we need an index. Number one is it's a representative of an economy. It tells how an economy is performing. If the index is going up, with very high probability, you can say that the economy is also going up in a long term horizon. Second is it gives a broad perspective whether the stock market is going up or down. So you might be hearing the news that today the stock market went down by 2% or went up by 3%. So it gives a broad perspective how the stock market is performing. And finally, not just the stock market, it also talks about some sectors how they are performing. So for example, if pharmaceutical sector is not performing so well, the index of that pharma sector will be showing a downfall. So these are the three main reasons why we need an index. But the most powerful reason for us is to invest in the economy through index fund. So we'll get to that. Now, how an index is created. I've taken an example of the broadest index of India, which is Nifty 50. Now, what we do is the representative company from each sector is selected. So the Sensex body actually looks at these representative companies and they create this index. And this exercise is repeated every, say for example, 6 months, to see if some of the companies have fallen out to being a representative company, they should be replaced by some other company. So it's fairly correlated with the economy. So for example, automotive, they will pick up companies which represent the automobile sector of the country. They are the leaders like Bajaj, Eicher Motors, Tata Motors, Hero, Maruti, Mahindra. These are the leaders in the automotive sector. It is not possible that the automotive sector is doing good and these companies are not doing good. It's not possible. If automotive sector is doing good, these companies will be doing good and vice versa. Similarly, if in financial sectors, these are the leaders of the financial services. Axis Bank, HDFC Bank, Bajaj Finserv, and so on and so forth. In IT, again, the leaders of the IT industry, TCS, Infosys, HCL, etc. Pharma sector, telecom, metals, consumer goods, energy, services, media, construction, cement, and fertilizers. So practically every aspect of the economy is captured here, and the representative companies is selected. So if you buy this, you are buying the economy. They're practically buying the economy. That's a very powerful concept. Simple concept, a very powerful concept. Now, each of these companies are not equal weighted. They have a different weight based on how much weight they have on the economy. For example, financial services have a very strong weight on the economy of the country. They will have much more higher weightage than maybe for example, media. So each company will have a weight based on which the index value is calculated. You don't have to go to the nitty gritty of it, but you should understand that how much each company represent the economy is actually covered by the weight. So that takes care of that. Now, why investing in index is ideal for retail investor? There are 5 reasons, and if you understand this, you will clearly understand why America is gung-ho about index fund, why it has been proven that index fund is much better way to invest for retail investor than any other way. Number one, if you buy the broad index, which is for example India's Nifty 50, you are practically buying the Indian economy. You're buying a part of the Indian economy, and that's a very powerful concept. That's not ordinary at all. Second, you don't have to actively figure out which stock to pick because the regulatory bodies, etc., they make sure that the only representative companies of the economy is picked up. So you don't have to actively look for that I should pick this stock, I should pick that stock, and you may go wrong. You don't have to do that at all. And because it is tightly tied to the economy, your investment is good if the economy is growing. There's a strong correlation between the growth of index and the economy. As long as the economy grows, your investment will grow. And historically, this is very important. Historically, in all developed nations, index fund has beaten all actively managed fund. So even hedge fund for that matter. So you give your money to some lucrative, fund manager who is managing your money, taking 3% of your capital to manage the money. He will not outperform the index fund. Index fund will outperform with high probability. Index fund will outperform. So historically, it has been proven. And finally, the expense of investing in index fund is one of the lowest. So if you invest in an index fund, the fund manager takes very small percentage, 0.3% or maybe 0.2%, in some cases even 0.1%, very, very small percentage, because they don't have to actively pick the stock. They just have to pick the stock is already there in the index. And we'll talk about how a fund manager actually does manage the index fund. So, but index is a hypothetical entity, it's a collection of stocks. How can you invest in an index? For that, we will cover the concept of index fund. Now what is index fund? There are a lot of investors. They pool in their money in the mutual fund, which is managing an index fund. And there's a fund manager. What he does is the same proportion in which the index was calculated, in same proportion he will allocate the fund. Even a robot can do it. You don't even need a fund manager here. You can have a robot doing it. That's why the expense ratio is very, very low. And it actually mirrors the index. If the index goes up by 10%, your portfolio will go up by 10%. The index go up by 5%, go down by 5%, your portfolio will go down by 5%. Exactly mirrors the index. But how do I choose which index fund to buy now? This is something that I will show in practice, how to actually choose an index fund. So now what I will do is I will switch to a very popular site in India, moneycontrol.com, that captures data of a lot of mutual funds. And then we'll see how we are actually selecting an index fund that we want to buy. So here we are in Money Control. I'm going to mutual funds, and I will scroll and I will pick the index fund category. So you have large cap, multi cap, you have lot of categories. I'll pick up the one which has index fund. I'm scrolling and looking at all the categories which are available. So here we have index fund and ETFs. What I will do is only the direct plans I will pick. What is direct plan? Quickly to tell you, direct plan is the plan where you directly invest in the mutual fund instead of going through an intermediary. So you save on some of the cost which are related to intermediary. You can directly buy that mutual fund. So I'm just downloading the data, and now we will analyze which index fund to buy. The first thing that I will do is, I don't want to invest in a small index. I want to invest in the broadest of the broad index, which is Nifty 50. So I will just filter out the text that contains Nifty 50. So I have selected on Nifty 50. So it picks up all the mutual fund which is a Nifty 50 index fund. Now I will delete this because this is not a Nifty 50. This is Nifty 500. This is also Nifty 500. So I will not select Nifty 500. So I will just select these 3 mutual funds, which is tied to Nifty 50. I'll capture the data. Put it in another Excel, another tab. What you will notice here is that the performance is fairly constant. Because they mirror the index, their performance will be fairly constant. You see a major crash because the overall global market has crashed because of COVID-19 or coronavirus. Due to that, there is a crash. As an investor, you should not worry about this thing, because as the market crashes, you have an opportunity that your SIP will buy at a very low level. So when the market recovers, you will actually recover all that money. So now all you have to do is So for example, HDFC index fund, right? Now, if I go here and just click on HDFC index fund, you have this one Nifty 50 plan. Just click here, and here I can capture the data, which is scheme details. What is actually the expense ratio, which is 0.1, which is very, very low. It's fantastic. So I just capture this data here. Here the expense ratio is 0.1%, which is low expense ratio. Expense ratio. Now I go to DSP Nifty 50. So I go to DSP, Control F, DSP, DSP Nifty 50 direct plan growth, and pick the scheme details, and I see what is the it is 0.2, which is slightly higher. There's no reason why I will select DSP over HDFC when they are both mirroring the index. I have no advantage, so I will rather pick HDFC. But I'll just look at. I don't want to DSP equal Nifty 50. It's not a broad market index, so I will just delete it. I want Nifty 50, not equal Nifty 50. Again, Motilal Oswal is another one. So I just MOTI. This one. And I'm looking at the, sorry, there's a mistake here. This is Nifty 50 index one. Let's copy this. Control F. Yeah, here you go. This one. Nifty 50 index one. And I don't know why it's showing this. It should actually show the performance of that fund, not the returns. But there's some bug here. There's some bug here. It should actually give me data like this. I can actually go to scheme details and I'll pick the expense ratio. Now, similarly, you will get some expense ratio. Maybe it's like 0.17%, for example. All you have to do is you pick the fund which has the lowest expense ratio, which is HDFC index fund. The performance of HDFC index fund, DSP Nifty 50, and Motilal Oswal Nifty 50, they will all be same because they are mirroring the index. There's no point of taking any fund which has a higher expense ratio. I simply go and buy HDFC index fund. If I have a money, I will start SIP in HDFC index fund. So this is as simple as that. Picking the index mutual fund is simple. The concept of index fund is very, very simple. Managing it is very, very simple. So all you have to do is pick up an index fund, broadest of the broadest index fund. In India, it is Nifty 50. In US, it could be S&P 500. And you just, if you have bulk money, you can start with bulk investment, and then with each monthly installment, you can do a SIP. This is as simple as that. So this is the concept I wanted to touch here. That we will in further session, we'll see how much money to allocate in these funds, etc. But by the end of this session, you should have very good understanding what the index fund is and how to select the index fund that you want to invest in. Thanks for watching.